Hello everyone, and welcome back to our financial analysis channel. Today, we will be forecasting the gold price for January 28, 2026. This is an extremely important moment for the gold market, as gold prices are currently at historical highs, and global investor sentiment is extremely sensitive. Today's video will analyze the market from a global perspective, while focusing deeply on the U.S. market, because gold is a global asset, but the United States determines short-term price direction. Every major movement in gold begins with global developments and is amplified through the U.S. market. So, what is happening globally right now? Where is the U.S. economy in the current cycle? How will the Federal Reserve act? And how will gold react on January 28, 2026? We will break everything down step by step. This content is for reference only, and is not investment advice. Now, let's begin. First, let's look at the broader global economic picture. The global economy is facing multiple risks. Worldwide growth is showing signs of slowing. Inflation remains a major issue in many countries. Global monetary policy is becoming increasingly fragmented. Some central banks are beginning to ease policy, while others remain cautious and restrictive. This creates instability in global capital flows. Geopolitical tensions continue to escalate. Several conflict zones show no signs of de-escalation. Supply chain risks are resurfacing. Energy prices remain highly volatile. All of these factors are increasing global investor anxiety. When risk rises, capital naturally seeks safe havens, and gold has always been a traditional choice. It is not tied to any single government and carries no credit risk. This is why global demand for gold has surged. Central banks continue to accumulate gold to diversify foreign reserves and reduce reliance on the U.S. dollar. This provides long-term structural support for gold. However, much of this information has already been priced in. Gold prices are currently at elevated levels, which increases the risk of corrections. Therefore, short-term direction will be determined by major financial centers and, most importantly, the U.S. market, where global capital converges and reacts the fastest. The United States remains the world's largest financial hub. The U.S. dollar is the global reserve currency. U.S. Treasury bonds serve as the global benchmark asset. Therefore, any movement in the U.S. directly impacts gold prices. The U.S. economy is entering a phase of slower growth. Several indicators suggest cooling momentum. Inflation has declined from its peak, but remains above the Fed's target. The labor market is showing signs of divergence. Job creation is slowing. This raises concerns among investors. A technical recession cannot be ruled out. U.S. equity markets are highly volatile. Elevated valuations increase correction risk. Capital is shifting toward defensive positioning. Gold benefits from this sentiment. The U.S. dollar has shown signs of weakening. Treasury yields have declined. This creates a favorable environment for gold. However, the U.S. market is highly data-sensitive. A single economic report can rapidly shift market direction. Therefore, January 28, 2026 is not just about gold, but about the collective reaction of U.S. markets, including equities, bonds, the U.S. dollar, and Federal Reserve expectations. This is the key point investors must clearly understand. Before making any decisions, the Federal Reserve is the core driver of the U.S. market and the most important factor for gold prices. The late January 2026 Fed meeting is being closely watched by global markets. The Fed is currently maintaining high interest rates, but pressure to ease policy is increasing as U.S. economic growth slows. The Fed faces a difficult choice between controlling inflation and supporting economic growth. Markets expect the Fed to hold rates steady, but the messaging matters more. If the Fed signals a dovish stance, gold will receive strong support. If the Fed remains hawkish, gold may face short-term correction pressure. However, given elevated global risks, the Fed is unlikely to be overly aggressive. Long-term Treasury yields reflect this view. Rate cut expectations are declining, which supports gold prices. Every Fed statement can trigger major volatility, not only in the U.S. but globally, because the U.S. is the capital flow center, and gold reacts quickly. Therefore, January 28, 2026 is a day requiring extreme caution. Investors should avoid emotional trading and ignore market rumors. The Fed does not define gold's long-term trend, but it controls short-term volatility. This has been proven repeatedly throughout market history. Investors must remember this before making any decisions. At this critical moment, the U.S. dollar connects the U.S. market with the world. When the dollar weakens, global gold prices tend to rise. When the dollar strengthens, gold comes under pressure. Recently, the dollar has been trending lower due to expectations of future Fed easing. Global capital is shifting from dollars into gold. U.S. Treasuries also play a critical role. Falling yields reduce dollar attractiveness and increase gold's appeal. Global investment funds are increasing gold allocations. This is a global trend, not limited to the U.S. However, these flows are highly sensitive to U.S. data. A dollar reversal could trigger sharp gold volatility. Therefore, investors must closely monitor the U.S. dollar index, U.S. Treasury yields, and global market reactions. These are leading indicators for gold price movements, especially during sensitive periods when prices are at historical highs and market sentiment is fragile. Understanding global capital flows is the key to understanding gold, and the U.S. sits at the center of those flows. These two factors cannot be separated in any serious analysis. Based on the global backdrop and U.S. market conditions, we can outline several scenarios for gold. The bullish scenario: global risks remain elevated. The Fed holds rates and signals dovishness. The dollar continues to weaken. Gold breaks into new highs. The neutral scenario: the Fed holds rates with neutral guidance. Gold trades sideways within a wide range. The corrective scenario: U.S. data surprises to the upside. The dollar strengthens sharply. Gold pulls back in the short term, but the long-term trend remains intact. January 28, 2026 will be highly volatile. This is almost certain. Investors must manage risk carefully, avoid all-in positions, avoid FOMO, and avoid emotional trading. The world creates risk. The U.S. sets the rhythm. The Fed drives volatility, and gold reflects all of it. Understand the world. Understand the U.S. and you understand gold. Thank you for watching until the end. If you found this video helpful, please like and subscribe. Don't forget to turn on notifications so you won't miss future analyses. Wishing you safe and disciplined trading. See you in the next video.